All right, everyone. Good afternoon. On behalf of Columbia University and our Masters in Wealth Management program, it is an honor to welcome you all to this, our 12th Speaker Series event, where from time to time, we have industry leaders come and share with us their thoughts and perspectives on our fast evolving wealth management profession. Our topic today is M&A in wealth management, and my name is Philipp Hecker. I'm a senior advisor to Columbia, and I'll be your moderator today. In terms of housekeeping, this webinar is being recorded, and you can enjoy a replay later on the Columbia Wealth Management website. Before I introduce our two very special guests who will really bring this topic to life, please allow me a few short words on our Masters in Wealth Management program, and let me provide you with a brief outlook on the arc of today's conversation. Columbia University's Masters in Wealth Management program is a 16-month part-time online program that prepares experienced and aspiring wealth management professionals to meet the many challenges and opportunities that our industry provides today. It is the only Masters in Wealth Management currently offered by an Ivy League institution, and it also provides students with all the educational requirements to attain the Certified Financial Planner designation. You can learn more by simply typing Columbia University and Wealth Management into a web browser of your choice. And also, if you're interested in attending an information session, we also have one coming up tomorrow. You can find out more on our website and register there. And last not least, if you are interested in applying for next year's cohort, which starts in the fall of 2026, priority applications are due Jan 15th, and the final application deadline is May 1st. With respect to the arc of today's panel conversation, first we'll get to meet and benefit from our guests' thoughts on current M&A dynamics in wealth management, getting perspectives from both the sellers and the buyer's point of view. Towards the end, we'll open it up for questions from our students, faculty, and other guests. So folks, please submit your questions online in the Q&A box as we go along, and I'll be feeding them to our panelists. And with that, it is a great privilege and pleasure to introduce our two guests for today, who will shed light on this important topic from a variety of angles. We're joined today by Jessica Polito, founder and CEO of her own M&A advisory firm named Turkey Hill Management. We are also joined today by Mike LaMena, CEO of a nationwide $30 billion plus AUM RIA firm called Wealthspire Advisors. Mike, it's great to see you again. Thank you for joining.
Philip, thanks for having me, and thanks for Columbia for hosting this. Really excited for the conversation today.
Awesome. To get us going, both Jessica and Mike, perhaps in that order, our students always enjoy learning about different firms and jobs available in our industry. So to that end, would you mind briefly introducing yourselves and your respective firms?
Okay, well, my name is Jessica Polito. I'm the founder of Turkey Hill Management. We provide M&A, predominantly sell-side advisory work in the wealth management space. My personal background has always been in mergers and acquisitions, specifically for both the wealth management and also institutional asset management sectors within kind of asset management. I was a partner at a prior boutique investment bank before starting this one almost 5 years ago. We work specifically with independent registered investment advisors, or RIAs, helping them on their journey to find partners. When I set the company up, I wanted to do it in a way that resonated a little bit better with the market that we serve. And when you think of a traditional wealth manager, they are fee only, or at least fee based, because they are not interested in charging their clients surprise fees or taking commissions off of the securities that they can sell to them. But when it comes time to sell your company, you have to go hire a registered broker dealer who is going to take that commission in the form of a success fee, which is a percentage of the deal consideration that gets paid at closing. So in order to better align ourselves with the clients that we serve, we do not charge a success fee. It is strictly retainer based, cancelable at any time. So the client never has to question whether the advice that we're giving them is in our bank account's best interest or their own. We are a 6-person firm located all around the country. We'll announce about 20 deals this year, making us one of the more prolific advisors in the space, likely on track to do more next year.
Excellent. Great to have you on this conversation. And in my mind, at least, you have two hats on, if you will, for this conversation. Number one is broad M&A advisor looking at dynamics across the street. And then, as you alluded to, you very much understand the seller's point of view, the seller's perspective. So thank you for bringing those perspectives to the table today. Mike, if you don't mind, likewise, please introduce us to Wealthspire Advisors and perhaps your path to CEO. Well, that would be great too.
Sure. Thanks, Philip. Awesome to be here. So I'm Mike LaMena. I'm the CEO of Wealthspire Advisors, as Philip indicated. Wealthspire Advisors is a $33 billion RIA focused on servicing high net worth and ultra high net worth individuals, families, and to a smaller degree, foundations and endowments on the low end of that scale. We have 25 offices across the country, 400 people. We've historically been a wholly owned subsidiary of NFP, which is a large institutional business focused on the insurance space, retirement space, employee benefits, a large diverse financial services organization, but a business that's probably best known in the insurance brokerage space. The reason I mention that is because Wealthspire is in the process, along with 4 other individual and institutional wealth businesses, from being carved out and spun out from NFP and our parent organization, Aon, and being taken private by Madison Dearborn, an elite private equity firm. So those 5 businesses are being rolled together. I've been asked to become the CEO of those combined businesses. We will be 1,100 people strong across 45 offices in the US, Canada, and the UK, focused on individual and institutional businesses. It's a really exciting time, as we'll talk about, M&A. I've been on the buying side, the selling side. The volume of activity, the pace of activity on the M&A front is really reshaping the individual and institutional independent wealth space, and excited to talk about that today.
It's awesome. In my mind, too, you bring the acquirer's view to the table, the buyer's view to the table, while going through a super interesting transaction yourself at this point in time. So I look forward to that conversation. Before we dive in, a couple of icebreakers, real quick and snappy, to get to know you even better on the personal level. Jessica, always ladies first, always starting with you. Favorite books, if you don't mind, share one fictional and one non-fictional.
Oh man, okay. I had 2 prepared, both from the same genre, because I really do not have the patience for fiction. So I recently, I think, came late to the table reading Unreasonable Hospitality. If anyone else has read that book, if you haven't, strongly recommend it. It's wonderful. It's the one of the owners of 11 Madison Park. Oh, there we go. Perfect. Who basically talks about.
Darted over to the bookshelf real quick. Couldn't agree more. A wonderful read for all of us.
Yeah, I love it. It's basically just like a very easy read on how not hard it is to go above and beyond in client service and how much of a difference it makes. I really, really like that one. And then I also just completed Salt, if you've read that one, which has nothing to do with business, but it's just super interesting. It's on the story of civilization through salt and how, it like industrialized and how it was used as food preservers and establishing trade routes, and the fact that the word salary actually comes from the Latin word sal, which means salt, because the Romans were paid in salt. Super interesting, but nothing to do with what we're talking about today, but strongly recommend.
Excellent. Thank you for sharing those 2 tips. Mike, what's on your nightstand or wherever you read?
Sure. So I was an undergraduate English major, which is an interesting story of how I spent, 30 years in the financial services world. So on the fiction side, I would have to just go back to my, English major roots and anything Shakespeare. On the other side, I would say, range, why generalists triumph in a specialized world David Epstein, who I think is a Columbia graduate. It's a great narrative. I've always valued that the wealth management business is about breadth, right? I never wanted to be the deepest subject matter expert in a narrow vertical, like somebody who traded municipal bonds and new municipal bonds at a more granular level than anybody else in the world. So wealth management has always been a platform where if you were a generalist and had breadth of understanding and were multivariable, you could succeed. And Epstein does a great job of talking through examples of athletes, artists, scientists who are generalists and how they often find paths, discoveries, are more creative and make connections that, in a world that's increasingly specialized, deep specialists may struggle to find. So it kind of directly challenges the 10,000 hour rule, driving success, and really is a kind of platform for generalists to demonstrate their value. So that's what I would go with, Phil.
The power and importance of connecting the dots, of horizontal thinking. Yes, thank you for sharing those two tips. Real quick, one more icebreaker type of question. If you could invite two guests to dinner, dead or alive, anybody, who would it be? Jessica, perhaps you first again.
Okay, so I thought about this morning and I was racking my brain for like an unconventional answer. And finally, and I don't know this is the answer you were looking for, I landed on my two grandfathers who I never got to meet. And I think that would be pretty cool because I think they have some pretty cool stories that I would love to hear firsthand.
Connecting at the personal level over time, a big theme for myself as well. Mike, who will be your dinner guests?
It's funny, like we did not compare notes ahead of time, but we're hitting on some similar themes. So I have three daughters, two are away at college, one is a senior in high school. This is going to sound hokey, but I would invite my two daughters who are away at college because I think I'm acutely aware of how much I took for granted the opportunity to have our whole family together and to share a meal. And now it's so much more complicated, complex to try to coordinate schedules across multiple geographies to be able to do that. So, that's where my heart pulls me on that question, Philip.
Well, now we're all crying.
Fair to say, both of you seem like family people, which is awesome. All right,
absolutely.
Let's dive into the topic of M&A in wealth management. And we're actually going to start by me sharing some data-based perspectives I was able to gather in preparation for this call. M&A in wealth management, it seems to be booming. In terms of number of deals, there are two big surveys out there that are oftentimes being referenced from DeVoe and Echelon. They see not exactly the same numbers because their methodologies differ, but they see obviously on the left in particular, but also on the right, M&A booming in terms of number of deals. To note here, these deals focus on larger firms in the RIA space only. The many smaller lift-ons, add-ons, individual advisors docking onto other firms are not included here because those are hard to track. They're not always being made public. In any event, I think it's fair to say M&A continues to grow in our space. And by the way, if the good fairies at Columbia could put the links to the surveys into the chat, that would be great. For those interested, they can download the studies right here, right now. DeVoe dives deeper into who is actually selling and buying, who actually stands behind those transactions, how are they composed, what are they made of? And here is an answer to the question, who is selling? The color coding on the right of these columns, they all add to 100%, obviously indicates the size of the seller. And as you can see in the past, about half was small firms in DeVoe's definition, which is 100 million in AUM to $500 million. As you can see here, as of late, seller firms tend to get larger. In particular, the segment of $500 million to $1 billion seems to be growing. In terms of who's buying, here is the DeVoe perspective. It is roughly half consolidators, a quarter to a third RIA firms, and then a bunch of other, assumingly including, the PE sponsors, the financial sponsors that Mike mentioned earlier on on the right of the page, you see an overview of some of the top acquirers in 2025 year to date. Last slide reel here, both studies list some of the largest, transactions. And as Mike mentioned, the one that he was involved with, is actively involved with, Madison Dearborn buying Wealthspire and other assets from Aon, is, top of that list. On the right of the page, interestingly, in terms of is it minority or majority investments, as you can see here, it's a fair mix. Those just some data perspectives that our panelists may reference to in the comments, as we tickle back into our conversation. With that, let's go into a couple of rounds of questions. Perhaps, Jessica, we start with you. As we have just seen, M&A activity continues to grow in wealth management, focusing on the RIA segment. If you could paint the picture, what is driving that increase in activity? Why is it going up? What's the strategic rationale for firms selling and or buying?
I think the backdrop, right, kind of going back before the main point, is that for as long as there have been founders of RIAs, typically those who have broken away from wirehouses or large investment banks to go independent and kind of do things the way that they think is the right way to do it. There are founders who are aging and don't have succession plans and eventually need to monetize their business, which is why, even looking back, 10, 15 years, 20 years, there has always been a steady flow of deals that have occurred in this space. We have seen a massive uptick in the amount and the complexity of the deals that are getting done in the last 5 or 6 years. And that is due in no small part to the fact that private equity has woken up to the fact that wealth management, like at worst, is an annuity, right? You have sticky clients, you grow with the market, you don't really have turnover among staff, expenses are pretty much fixed. And all you have to do is add a little bit of capital to either help them invest internally, hire a C-suite, or go out and grow inorganically through M&A. And all of a sudden, you get these tremendous returns on your investment. I think if we look back more than 5 or 6 years ago, the activity that was being done with private equity investing in wealth management was really among the much larger players, right? When you think about the amount of money that private equity wants to invest, they want to spend hundreds of millions of dollars, right, on each one of their acquisitions. So it was TA Associates, it was KKR, it was like the big name brand private equity firms that were investing in the Mariners of the world and the Wealth Enhancements of it, were the really big firms, right? And then it was like as if all at once they all woke up at the same time and said, wait a second, I can invest significantly less money in maybe a $10 billion RIA or $5 billion RIA or $20 billion RIA. And it's much easier to get these firms to double or triple or quadruple in size than it is to take a $100 billion firm and get them to do the same. So you can get a much faster ROI by investing in these smaller firms, because all you have to do is arm a $10 billion firm with some capital and they can start acquiring $300 million, $500 million, $700 million firms. In a more saturated market where there are more buyers that are capitalized than ever before, there is more competition. I know this is wealth management, but everyone understands economics. So what that has done in turn is created a very competitive landscape for buyers. Mike is nodding his head because unfortunately he's part of it too. But it's also created opportunity because it means the sellers have the option to actually go and find cultural compatibility among the partners that exist out there for them. Instead of just kind of having a list of 5 firms that they kind of have to hold their breath and sell to and hope for the best, because that's all that can afford them, right? And what it's allowing buyers to do is be more selective in who they actually decide to partner with, because there's more of a selection. Because sellers are hearing, well, I have 3 friends that have sold their companies, maybe I should too. And, buyers who maybe have a mandate or an interest in growing by acquisition have much more to choose from. So it's kind of a win-win on both sides. but it's certainly keeping multiples high.
Excellent, Jessica. Two quick follow-up questions there, if I may. Number one, in terms of the RIA market structure, keep me honest, but my impression is the count of RIA firms, which is, you keep me honest, 15, 16,000 strong, keeps on being large and growing itself. Yes, there's some consolidation, some M&A, which is what we're talking about. But to your point of supply and demand, the supply side of that equation keeps on growing as well. Is that fair?
It is fair. And I have a little hypothesis among myself that I suspect that the next wave of new RIAs are going to come from the disgruntled 25-year-olds that were sold to some of the large aggregators, maybe, 10, 15 years ago, who are now, 40 and have their own books of business and understand kind of what's going on and end up breaking away. The same way that maybe their predecessors did from, Morgan Stanley or whatever 30 years ago. So I think, as long as people continue to have an entrepreneurial spirit, they will continue to find ways to improve on what exists currently in the wealth management space, which in and of itself is evolving so rapidly.
Excellent. Yes, my second quick follow-up question would have been around deal logic and buzzword multiple expansion. I think you alluded to it in your description already, but is it fair to think that individual firms, for business logic reasons, tend to fetch a smaller multiple than larger or mid-sized firms? Thus, the aggregating adds value from a multiple expansion point of view. Is that at least partial driver of the increase in activity?
That is a very nice and simple way to put it. So I think, like, if you had to bucket, is a $300 million firm going to achieve the same multiple as a $50 billion firm? The answer is just absolutely, categorically no. Absolutely.
On that note, would you mind sharing real quick, what do you see? I know it always depends, but just ballpark, what are the multiples for smaller versus larger firms?
Well, what I was getting ready to say is that even if you had two, call it $500 million firms, I mean, one could be a sleepy firm full of, founders in their 70s and 80s who haven't grown in years and don't have successors. That is going to trade at a very different multiple than a $500 million firm that was $300 million 4 years ago, right? And has found a way to grow organically and has started investing in technology and has next gen in place. You could be talking about like a 5x EBITDA multiple spread between those two firms, right? And I guess maybe the next natural question is, why would anyone buy that first sleepy firm, right? And the answer is because multiple arbitrage, right? If you can buy the sleepy firm for 8 times and you yourself as the buyer are trading at 20 times, then you're capturing that 12 times multiple in between, right? When you ultimately have your liquidity event as a larger firm. Ostensibly, you're also helping to add to the books of your next gen advisors, right? I mean, if you have a bunch of 75 and 85-year-olds, they're probably not working for much longer, but you probably have someone at your firm who is 25 and ready to kind of start taking on some of their smaller clients. So there are lots of reasons why that type of deal would make sense, but certainly would not pay the same multiple for a business like that as one that has like significant growth potential within a larger firm.
Thank you for sharing that. Mike, at this point, let's perhaps weave you in. I think of Wealthspire as a firm that fires on both cylinders, meaning you drive growth the organic way and the inorganic way. You acquire other firms. If you don't mind sharing, what is driving your M&A strategy? Why do you keep on adding new firms? What are your experiences around that? And what's your approach, perhaps?
Sure. So I would say two fundamental things. One, talent, and two, scale, right? So if you think about, we're in a professional services business. We don't have, millions or billions of dollars wrapped up in factories or, IP. The most valuable resources we have are the talent that we bring together and the culture we create that allows that talent to thrive. So M&A for me has always been about, can we attract really talented people, bring them into our ecosphere, and allow them to reach a higher potential as part of a larger organization. And in some instances, we'll intersect with a smaller RIA, and we know we can communicate to them that we're going to be able to take off, peripheral hats. They're not going to have to worry about HR and compliance, and there'll be a centralized investment team that they can plug into. So it allows an advisor to actually get back to the thing that got them into the industry to begin with, their highest and best use, which is working with clients, driving growth, impacting families in a positive way. So for us, M&A has always been about talent. When I look at how, Wealthspire grew from a $6 billion RIA to a $33 billion RIA, the 14 acquisitions we didn't just drive an increase in AUM and revenue and EBITDA, it significantly expanded the talent pool. And we have people all throughout our leadership ranks that have taken on bigger roles and grown professionally because they had a bigger stage. For some, it's about a more focused role. So M&A, first and foremost, is about talent acquisition. It is very competitive to hire all the talent you need organically. Every day, there's more and more articles about the demographics of, people aging out of the independent wealth space and the need for more talent to fill that gap. So M&A is clearly about talent acquisition. The second thing, and these two are interconnected, is scale. Like if I go back, a decade and a half, 2 decades ago, the argument used to be that, if you were on the independent RIA side, you were able to exercise a fiduciary commitment to your clients. You could be seated on the same side of the table, aligned in interests, but you were going to sacrifice access to the best capabilities, resources, technology platform, access to investment solutions. And over the last decade and a half to 2 decades, that paradigm has shifted dramatically. As a result, there's been an arms race among independent RIAs to build the scale necessary to give more capabilities for advisors to meet the increasingly ever-growing demands of clients. Now, I think that's awesome because what we deliver for clients is so much richer, deeper, more robust than it ever has been. But, you used to get reimbursed by clients through their fees for asset allocation and maybe manager selection, and that was the value proposition. Then you fold in, sophisticated financial planning. Then you add multi-generational trust and estate planning. Like we've done M&A acquisitions that have brought, scaled family office accounting capabilities, so we can be the outsourced financial back office. Think elite athlete, business owner, entertainer. They have multiple residences. They're working in multiple geographies. Their tax, situation is incredibly complex. They want somebody to be the trusted quarterback of their entire financial life. You can't just lead with financial planning and investments. You have to have family office accounting capabilities. Last year, we launched the de novo trust company so we could integrate the trust solution set in what we do. So for me, M&A has been about attracting talent, creating an environment where that talent can thrive and reach a higher level of professional fulfillment, success, achievement. And then it's also about scale, which gives you the resources and ability to invest in all the arrows you have to put in the quiver of advisors to meet the ongoing demands of clients.
Excellent. Folks, we have some great questions coming into the Q&A line. Please keep that up. We will address some of them when we circle back to Jessica. But before we go there, Mike, I have a follow-up question to your framing of the comments. You alluded to it a little bit already, but when you look at a potential M&A target, when you assess a firm you may want to acquire, beyond talent, what are the specific factors that you look at? How do you assess and rate your M&A targets? Please be as granular as you feel comfortable to give everybody a feel for what are you looking for, what's a good fit from your perspective.
Yeah, so I'll start, 50,000 feet and then get more granular. There has to be the right cultural and business fit. In my experience, like if you're not aligned from a cultural standpoint, you're going to have so much friction on an ongoing basis. And that means a lot of different things. The way I look at the industry is, advisors fall on a spectrum. Where do you want to be? You can set up your own RIA, have 100% autonomy, make every decision, and have your own brand. And that's one model. On the opposite end of the spectrum, you can be an advisor in a large, wirehouse organization. You're going to have very little autonomy. You're going to have a lot of support behind you, resources. And then there's this whole meaty space in between that advisors have to figure out and team members have to figure out where are they going to thrive most. So, Wealthspire is a full integration model. It's not a simulation. So, we give people, I think, the right balance of, the consistency of the experience. So it's common brand, common centralized investment process, common CRM and technology, platform, but we preserve the ability for advisors to exercise their unique best self in the final mile delivery to clients. We embrace that every advisor has to find the people they want to work with and build specialty practices, whether that's working with attorneys, doctors, business owners, athletes, women going through, transition, premature death of a spouse, divorce, career change, you name it. We have advisors that have specialty practices. So I think we've created that balance. Well, how does that show up when we start to evaluate potential acquisitions, right? If somebody doesn't buy into full integration, it doesn't mean they're a bad advisor. It means they're not the right fit for Wealthspire and what we're building, right? So if I have somebody who's fiercely protective of their brand, really wants to make every decision themselves, and Jessica and I have been in these conversations, you're going to guide that individual to, an opportunity that says, you want monetization, you can get monetization, but don't join a fully integrated platform. You're going to be miserable. The buyer's going to be miserable. It's not a cultural or a business fit. So that has to be there. I think then you start to look at all the criteria that Jessica started to talk about. Like we're going to look at, do they have, succession built into the firm? Is it just Gen 1 or have they developed, Gen 2 talent? What's their organic growth rate? What's the demographics of the existing client base? What's the average client size? How are they investing today? Do they lead with financial planning? Are they fiercely fiduciary? All those things kind of give us a picture of, is this organization going to fit into our model and the business that we're building? Then you're going to look at stuff like, okay, if it's a brand new office for us, do they have the critical mass for us to establish a brand new office? For us, that means if it's a new location, probably 250 million in assets under management, and similar. If it's a tuck into an existing location, maybe we can go as low as 100 million in assets under management for a transaction to make sense. But there's a whole abundance of qualitative and quantitative criteria that you're going to use to assess, is this an attractive option? And to Jess's point, like that leads to, what multiple am I comfortable paying, right? I'm not going to pay the same multiple for a business that's growing at 1% absent market versus a business that's growing 8% year over year organically absent market. When you fold in 5% market, they're growing at 13%, and they've got succession talent built into their organization. I think the other thing I would say is, you can't just look at a potential acquisition in the present. You have to be able to project forward. How is that business going to operate once it's part of, in my case, Wealthspire? Because that allows you to say, all right, maybe the organic growth hasn't been everything that it should have been historically, but if I connect them to our talent, take off all the peripheral hats, provide leverage, provide a centralized investment research capability, take off compliance and HR, and allow those advisors who are passionate about serving clients more time back, can I accelerate their growth? That's where you start to get excited, because I'm valuing it based upon, to some degree, the current view of the business. But if I believe I can make that business better by giving them leverage, enhancing capabilities, that's where you start to see I can create real value and upside for both the buyer and the seller. And typically our transactions, we're offering an upfront monetization event, a multi-year earnout structure. Now that we're going to be private equity back, we'll be back in the business of allowing people to roll some equity, which has been a challenge for us the last, couple of years. All of those things are aligning instruments that allow people to say, all right, let's grow together. And if 1 and 1 is a heck of a lot more than 2, when we do that math, I think both buyer and seller can have a lot of conviction that it makes sense.
Super interesting. 2 quick reactions, and then we'll weave in an audience question before we go back to Jessica. My 2 quick reactions to the rich information you shared, which was super helpful, are: number 1, I, like you, celebrate the fact that being a wealth manager, being a financial advisor, can have so many different permutations. For us as employees, that presents ultimate choice, right? Even within the RIA space, as you alluded to, the models and the cultures are quite different. So from an employee, from an advisor point of view, an abundance of choice as to how one wants to spend the working, part of our lives, which is awesome. Now, it can be confusing for investors and clients. There's a flip side to that coin, but from an employee point of view, an abundance of choice of models, which is wonderful for our younger colleagues or career changers in the audience right now. The second,
there's never been a more fertile set of options. I think, if you're someone who's contemplating an M&A transaction, that's why you need to work with somebody like Jessica, because they can help guide you and help you figure out, like, this is the right fit for you. Don't be, don't get really attracted to a high multiple in a platform that's not actually aligned with what you want and how you want to operate your business. You can have a lot of seller's remorse if you chase a dollar sign and don't actually put yourself in a position where you're really going to thrive based upon all those other factors.
Absolutely. The next block, Jessica, will tee that up for you, nicely. Okay. So bear with us for 1 more minute. Mike, I also want to underscore what I heard from you is you assess potential targets in isolation, having a bunch of thoughtful criteria, and you assess the fit with the firm today and from a go-forward strategy point of view, including as basic a question, real estate. Do we have an office? Do we need to create a new one? So looking at deals in isolation and in context is a second key takeaway. Now, Mike, let's circle in here a great audience question from Matthew, who's wondering, you alluded to the importance of post-merger integration and, values are aligned. Do you have some best practices? Do you have some tips, some do's and don'ts to make that come true?
Yeah, I mean, look, what I would say is you need to be relentlessly transparent and honest on the front end about, like, what your model is, what your expectations are, and you also have to probe, right? Sellers are often swept up in a process. They're in front of countless potential suitors. I mean, Jessica talked about how competitive it is right now. It's easy for someone to start to provide the answers that they know buyers are going to find most attractive. You have to push and really challenge and figure out, has the seller actively thought about what the world looks like post-transaction? I've seen too many people that focus on everything leading up to the successful completion of the transaction. They don't spend enough time thinking about what's life going to actually be like post-transaction. And that's for everybody on the team. But if you think about a seller who's run their own business for 25, 30 years, they haven't had a boss. They've been the answer person. They haven't had to check with anybody. They might get excited about, okay, I need to get a monetization event. I want to be able to position my next generation for future success. I want to ensure my clients have a home. God forbid something happens to me. When you start to look at those things, if they haven't really thought about, how am I going to function when I have a boss? How am I going to function when there's a budgetary process I need to plug into? How am I going to react when, I don't get my way on a decision, right? Those are real things that if the seller and the people on the team haven't really thought about, what does my day 2 look like, and am I excited about it? Do I see it through the lens of, scarcity or abundance? Do I see it as an amplifying opportunity to grow in different ways, to get back to highest and best use? or am I, really just viewing it as a transaction? So I would say the more that the buyer and seller get to know each other and really push and pull and probe, that conviction has to be robust and earnest. I always go back to two fundamental questions that I have to answer with a lot of positive conviction to move forward with a deal. Is the combination going to result in better capabilities, better outcomes, better solutions for the end client? If you can't answer that, you shouldn't be doing a deal. The second thing is the combination going to create amplified opportunities for the talent involved in a talent-based business that is absolutely critical? And it is absolutely personal. If you have a 10-person team, every person on that team is going to ultimately ask, what is the implication for me? And for some people, it's a bigger opportunity set. For some people, it's specialization and focus. For some people, it's the freedom to say, I'm ready to transition out of the business and I can do it because I know my clients are going to be taken care of by succession advisors that didn't exist in my old firm. So I think you got to lean into that to avoid the kind of bad deals that end up really, really, hurting everybody involved.
Excellent. Super good. We'll circle to bad deals and don'ts at the very end of our conversation.
Okay.
But let's weave in Jessica again. First, Jessica, let's close the loop on some of the great comments you made in our first discussion round. And then I have some de novo questions for you building on Mike's commentary, okay? So closing the loop on some prior comments, Bruce piped in a great audience question. You mentioned 8 to 20x multiple, as a range for a 500 million AUM or so firm. And Bruce is wondering, what is it based on? Is it revenue? Is it EBITDA? What is the 8x? What is the 20x of?
To be clear, I don't think a $500 million firm could get 20 times. That was for the much larger firms that are doing the buying. But the multiple is on EBITDA, earnings before interest, tax, depreciation, amortization. And the reason for that is because EBITDA in this industry is kind of the great equalizer, right? You could have two, kind of using the same point, right? Like $500 million firms, both of them are producing $5 million in top line revenue. One of them is able to do it with 3 people in Des Moines. Another person is able to do it with 20 people in New York City, right? Like their bottom lines are going to look very, very different. And if you're applying a revenue multiple or God forbid an AUM multiple on those businesses, you're either significantly overpaying for one or significantly underpaying for the other. Since these firms don't really have depreciation and amortization and all you're really stripping out is tax, and then kind of right sizing the business for as a pro forma kind of go forward basis. So we use EBITDA, it's the great equalizer. And that's multiples.
The multiple is of EBITDA, just to get the ranges right again. And again, it always depends. But for a 500 million AUM firm, what range do you see? 8x to?
For like a really special, fast growing firm, maybe like 14.
Excellent. 8 to 14 for a $500 million firm. And then again, directionally, the smaller the firm, the multiple would go down. The larger the firm, the multiple would go up, correct?
Yeah, I don't think that I think we've seen one deal in this space go for 26 times. And I don't think that that's going to be a trend that we continue to see. I kind of thought the ceiling would tap out at 25. I mean, never say never. That's so many times.
Excellent. Okay.
Yeah.
Now, real quick, second audience question based on your opening comments. You shared a personal hypothesis that some of the upcoming, jump to independence may actually come from quote unquote younger advisors that once were rolled up years ago by an aggregator may have gotten, disillusioned and now may want to try their own thing. Is that based on your observations, on your view of the market? Or James is wondering, are there any studies out there on that substantiate that hypothesis?
I think it's too soon for studies because those deals are only, 5 or 6 years old. The hypothesis really comes from the fact that if you talk to any advisor who is selling their practice that they started 20 years ago, 30 years ago, the vast majority of them started at Morgan Stanley or William Blair or whatever, and then kind of broke away to create their own. And we're still seeing, I mean, with the advent of these like transition platforms, right? Like Dynasty and Sanctuary and, all of these kind of like, halfway homes for advisors that are breaking away from wirehouses. Like it's still happening, right? From the wirehouses kind of in droves at this point. So there's still a desire to kind of hang your own shingle and become independent. It hasn't started happening yet, but just kind of knowing the personalities in the space and where all of the deals have been happening, I mean, I guess time will tell, but my suspicion is that's where they're going to come from.
You've heard it here first, an interesting hypothesis for at least a partial driver of future, M&A and RIA growth. Okay, Jessica, let's weave you in terms of reacting and building upon some of Mike's comments. Mike shared with us very much the buyer's perspective. What is he looking at when assessing potential M&A targets? Let's now take the seller's perspective. You represent a ton of sellers, as we've heard. Why do they tend to want to sell? What is driving their motivation? And then how do they assess acquirers? What are their factors when thinking about the best fit?
Yeah. So a lot of people come to us, and this sounds terrible, as a last resort, because they broke away from the wirehouses and because they've been preaching the importance of independence to their clients for the last 20 or 30 years and had every intention of staying independent until the day they die, until a lot of them hit their 60s and their clients also hit their 60s and start saying, well, what's going to happen when you retire? Well, what's your plan? And most of these founders just wanted to be advisors. They didn't want to be business owners. They didn't, start their company with a business plan and funding. They kind of just started with the clients that followed them over and kind of built it organically over time. So most of them don't have next gen, or if they do, the problem with next gen is either next gen is happy having a boss. They don't want to take on the entrepreneurial risk of the business. They can't run the business, or they can't pay to buy the business because these companies have become so expensive that as soon as a founder hears, well, listen, I'm willing to take a discount to the market just to keep my company name and keep my independence. And then they find out, but wait, I can sell for 12 times EBITDA. Well, I can't take a 60% discount just to keep it internally. Like I still have a fiduciary duty to myself, right? So they come to us and then they're like, well, I guess I have to sell my company, right? And then it becomes our job to say, well, it doesn't have to be an I guess. It can actually be something that is a tremendous opportunity, kind of like, yes, for you, but also for your employees and for your clients. And let us show you why, right? When you go and you partner with another firm, you have the option of partnering with a larger independent version of yourself, right? There's like a mental hurdle that a lot of sellers have, that selling means feeding back into the machine, going back into this like, corporate bureaucratic, now I'm going to be forced to sell, mortgages to my clients again. And that's just not the case, right? Like you go to a Wealthspire, you go to, some of the other independent firms that have the same fiduciary responsibility to their clients. They've just kind of built a better mousetrap, right? They've been able to grow organically. They've been able to grow inorganically. They've been able to add services. So now, like, guess what? You have a 5-person team and you're doing great in-depth financial planning, but you can go find a partner that does that, and also estate planning and tax planning and maybe even tax prep. And they have an in-house trust capability, and they have, whatever else, right? Where all of a sudden, your clients have access to alternative investments, and your employees have the ability to actually like have a career trajectory. And maybe you didn't know that, your 25-year-old client service advisor actually is very interested in like trying out marketing for 2 years. And now they have the ability to do that, right? Which is a lot of lip service, until the client actually gets to start meeting the partners and seeing for themselves, like, oh, you're not, this monster who's in it to just like, make as much money as possible. Like, you're just like me. You care about your clients just like I do. And look at all these things that you've been able to do. And wow, this is actually a very exciting opportunity. The nice thing about how robust the buyer landscape has become is that when people come to us and tell us, well, I have all these non-negotiables, I can pretty much name them, right? It's like, don't change fees for my existing clients. Don't fire my staff. Don't fire me. Don't make me move. Like, don't change my like work from home policy. Don't have like massive taxable events for my clients because we have to switch immediately to, you know, the investment philosophy of the buyer. And any good buyer will say, well, duh, right? Like, obviously, of course, we're not going to do that because we're not buying like paper mills. We're buying firms that have no hard assets. What we're buying are relationships and trust. And if we do anything as crazy as like fire the executive assistant who everyone is obsessed with, then everyone is upset, right? It's not just like the loss of a $60,000 a year expense. It's the loss of like client trust and you know, employees being like, I don't know what's happening. And it's a recipe for disaster. So when you can kind of understand that those are, yes, non-negotiables, but also like not even worth talking about because they're such table stakes at this point, you get to focus on everything that Mike was talking about, right? Like, what is actually important to me? Do I care that my clients have access to alternative investments, or, you know, have I like beaten it into them that they don't need it because they should be as liquid as possible? And what I really care about is, you know, someone to do their taxes because I can't find anyone with reasonable prices to do, you know, simple 1099s, right? And then it becomes a very exciting experience rather than a very scary experience. But it takes a lot of work at the start, actually understanding the client and the business that they've created and who they are as people and what their clients expect, you know, over the course of a year and their client experience, to then go and find them partners who look and feel a lot like them, but are, you know, maybe a little bit better.
Super interesting. Thank you for sharing. Couple of technical, you know, questions, looking for rapid fire answers.
Sure.
It seems to me that you work with clients and help them navigate to the best fit for everybody's benefit, as we've established. Rough numbers, rough percentage. What percent of your clients may start with a certain vision or idea and actually end up there versus getting positively, you know, nudged and changed by you into a different model? What would you say?
I would say close to zero.
Meaning?
Like close to 0%. Like, often we have firms that come to us and say, hey, look, you know, I've talked to these 3 firms. What do you think? And we're like, these firms have absolutely nothing in common with each other, and also nothing in common with you.
So you're saying almost always you pivot them, you redirect them into a better fit, into a better home?
And not because we have skin in the game, you know, and we'll work with them with, you know, making sure that they keep whoever they are already interested in, like, in the process and involved and all that. And then often what happens is that when you put the universe that's supposed to be in front of them, and this is not an economic thing, right? This is a cultural.
That's your value add in many ways in my mind, right?
Yeah, totally.
Yeah.
Okay, so
Philip, I would just add, like, look, it's a mutual discovery process, and you're on a journey together, right? So somebody has a preconceived notion coming in that they have to keep their brand.
Yeah.
And then they find out through the discussion that, like, I'm scraping nickels and dimes together to try to invest in my brand. I can plug into a larger firm that has invested, you know, millions of dollars in brand, can take that off my plate and free up more time. Somebody has, you know, a view that, you know, they have a non-negotiable, and then they start to figure out, well, is that really that critical to me? So I think the best processes are the ones where people come with curiosity, a desire to learn, an openness, because then the buyers and the sellers are able to find that balance to say, and you know it when you feel it. Like, when you feel the fit culturally, business wise, the alignment, like, that's where you get conviction. And I think the industry has matured enough that, like, a lot of people are willing to say, like, look, you're just not, this isn't the right fit. Go talk to somebody else. It's not like there's one avenue and you have to be, you know, going down that path. So, you know, I think that's it.
For everyone's benefit, as you mentioned prior. Jessica, real quick, talking of the process, I'm sure it depends, but how long typically do your engagements last? How long can the sales process, if it's being taken seriously, last for people? Is it order of magnitude, 6 months, 12 months, 24 months? What do you see?
It's about 9 to 10 months from I want to sell my company to like the money has hit my bank account.
Excellent, super helpful. I'm keeping my eye on the clock. We have 4 minutes to go. There's one more quick final question round I want to ask both of you, and I'm weaving in an audience question from Noah. And perhaps, Jessica, you first, then Mike. Most in the audience today, let's face it, will be potential sellers of businesses as opposed to potential buyers. So from a seller point of view, what are best practices to potentially structure one's practice, one's business from early on to maximize the potential of a future, exit? Meaning, what should you be watching out for potentially from the get-go or mid-career to make it easier, quicker, better, higher multiple down the road? And on the flip side, to Noah's comments, what are key risks? What are traps to avoid, in the process? Yep. If you don't mind, Jessica, first a minute, then you, Mike.
Sure. Well, I have like several answers for this. The first, I think like the baseline biggest differentiator between firms that achieve higher multiples and lower multiples is whether they're advisors or 1099 or W2'd. 1099 advisors own their client base and can walk away at any time. So in a transaction, buyers are unwilling to pay for revenue that's not sticky. So if you're starting a wealth management practice, W2 your advisors. That's like black and white. Outside of that, just build a practice that feels good to you. Because there is no such thing, focus on growth, but not, at the expense of your clients. Invest in your business. Don't run your advisors thin, because buyers can see through that and they will just tack on the cost of a new advisor, right? Treat your clients the way that you want to be treated and like enjoy the ride, because like ultimately if the market continues to look the way that it does now, it's not a question of like, if you do these 5 things, you're going to maximize your value. It's a question of like, if you can find the right fit for your business, the economics will follow.
Excellent. Very good advice. Mike, what would you share?
Yeah, look, I think from my perspective, we're in the business of delivering financial plans. And what's the foundation for that? We work with clients. We understand their hopes, their dreams, their fears, what matters most to them. And then we use all of our technical capabilities to try to create the right outcome. So if I think about a seller and a buyer, it's that same process of digging deep and understand what do you want to achieve in a transaction, and even more importantly, post-transaction. The more and the earlier you start to think about that, the better you're going to be positioned to create the outcome you want when you want it, right? Jessica talked about the timeline of a deal. There are sellers that wait too long. They wait until they're 72 years old, growth has, atrophied, they don't have succession planning, and then they want a premium valuation. Like that person needed to have a conversation 12 years earlier, right? Mm-hmm. I'm much more inclined to provide a higher level of valuation to a business with, a founder, a principal, a rainmaker that has runway, a business that has, succession talent built into the organization. So I just think the earlier you start thinking about, like, what do you want now? What do you want 5 years from now? What do you want for your business? What are your goals and objectives? The better position you're going to be to lean into the process and create the right outcome when it's the right time.
Excellent advice from both of you. We're at the appointed hour. So first off, to our audience, I hope that you got as many insights and thoughtful inspiration out of Mike's and Jessica's comments as I did. Thank you for joining. And of course, Jessica and Mike, on behalf of Columbia University, thank you for spending the past hour with us and sharing your invaluable perspectives. View yourselves as friends of Columbia next time you are in New York City. And I know both of you are often. Let's meet on our beautiful campus on the Upper West Side. Last question on the way out, real quick. Where can folks learn more about your respective businesses?
Go ahead, Jess.
turkeyhillmanagement.com.
turkeyhillmanagement.com.
Yeah.
Excellent. Mike?
Wealthspire.com, or you could email me at mike.lamena@wealthspire.com. Happy to engage. Our industry needs more talent, so people that are interested in this business, I'm always happy to have conversations. So thanks for the opportunity to share some thoughts today.
Thank you both. Thank you, everyone. Have a great rest of the day.